This is a video about cash flows. There are two methods to prepare a cash flow statement. We're going to do the indirect method of preparing a cash flow statement. A cash flow statement shows the change in cash, that is your beginning cash minus your ending cash, for the period, and it categorizes all of those transactions into three categories. The three categories are operating, that's cash flows from operating, investing, that's cash flows from investing, and financing, that's cash flows from financing. Under the operating section, you're going to start with net income, and the reason that we start with net income is it is the closest thing we can do to come up with our cash changes, and then we're just going to make some adjustments to it to get to our exact cash change, because it has some items in it that did not affect cash, so we're going to take those out. It also may have some items in it that do not belong under the operating section, so we're going to take those out of the operating, and if they belong in investing or financing, we'll put them there. Alright, so you start with your net income that you get from your income statement. Then you're going to add back any non-cash expenses, and those are typically depreciation and amortization. The reason for that is that it decreased net income, but it did not decrease cash. So we're going to add it back. Alright, now you may be thinking, but hey, when I bought the equipment, it did decrease cash. That's true, but we're going to take care of that when we get down to investing, because investing is where long-term assets go. Alright, so you're going to add back depreciation and amortization. Then you're going to remove gains and losses. I use the word remove because if it's a gain, you're going to minus it, and if it's a loss, you're going to add it back. Alright, the reason for this is that gains and losses we're talking about are related to long-term assets. They do not belong in the operating section. The proceeds from it or the expense of it belongs in the investing section. Furthermore, the exact gain or loss was not the cash transaction. That was just the difference in the cash and the book value. So we're going to remove it from this section. Next, we're going to look at current assets, all except for cash. So what we're going to have here are your accounts receivable, supplies, inventory, and prepaid expenses. Those are your main current assets. You're going to look at the change in them, and then we're going to be able to apply a rule to that. We're going to say that if current assets increased, then we will decrease our cash flows. And if there's a decrease in current assets, then that will be an increase in cash flows. And now I'll tell you why that rule will always work. We're going to use an example of accounts receivable, but the same reasoning works for all current assets. So here it is. If you have accounts receivable goes up, net over the period, then basically you had more transactions that look like this than the other way. Alright, so accounts receivable goes up and fees earned goes up. In other words, we accrued some revenue, or we, another way of saying that we did some work but haven't gotten paid yet. Alright, if that happened, what did net income do? Well, the only account here that affects net income is fees earned, and it went up. Okay, but did we get the cash? No. So to reconcile the net income that was increased by this to show that we did not get the cash, we would need to decrease it by the change in accounts receivable. It will work the same for all of the current assets. Let's look at the decrease. So let's say that we had more decreases. We would look at the transaction would look like this. This transaction would decrease accounts receivable. Did it affect net income? No. But was cash affected? Yes. So to reconcile net income to our cash flows, we would need to increase cash. So that's why if we have a decrease in current assets, we have an increase in cash flows. Alright, the next section that we look at is current liabilities. And by the way, we're interested in current because those are the things that are operating activities for a company. All right, so these are things such as accounts payable, salaries payable, and unearned revenues. These are our current liabilities. All right, an increase in a current liability equals an increase in cash flow. So notice there's a positive relationship here. Increase equals increase. Notice under current assets, increase equals a decrease. All right, so therefore it follows that a decrease in a current liability equals a decrease in cash flows. All right, again, let's look at a journal entry to see why this works. So if you have an increase in accounts payable, then you probably had some sort of an expense and some sort of an accounts payable. So here we're working off of the increase in current liability. Accounts payable went up. Let's look at the income statement effect. This would have decreased my net income because utility expense would have decreased my net income. However, there was no cash outflow, so we need to add back to cash for this one. All right, the opposite of that one would have been accounts payable going down. So we need to debit accounts payable going down, and we'd credit cash. So when we look at this one, there was no impact on the income statement, but cash went down. So that's why a decrease in current liability needs to decrease cash flows. All right, the next step would just be to net all this together, starting with net income, and you would get your net cash, either inflows if the number's positive, or outflows if it's negative, from operating activities. All right, your next set is investing activities, investments. All right, and so for this, you're just going to look at long-term assets. There's only two options. You either sold them or you purchased them. If you sold them, you're going to look at just your proceeds from sale of long-term assets. So notice I didn't say gains, I didn't say losses. I said how much did somebody give you, because this is all about cash. And the good news is that if you got money, then you're going to add it. If you paid money, you're going to subtract it. So the rest of the whole cash flow will be intuitive that way. The only time that we have to think about it otherwise is if we're comparing these current assets and current liabilities. All right, in other words, if we're reconciling this net income. All right, so then you can also purchase long-term assets. All right, then you're going to net that together and you'll get your net cash inflows or outflows from investing activities. All right, and the word investment here means long-term assets. What did you invest in your company to help your operations? That's why we use that word investing. The next section is your financing section. And under this section, we're going to have all long-term liabilities and anything that happens in your stockholders' equity section. This word comes from, for example, if you say, I'm going to finance my car. That means I'm going to get money from someplace other than my operations or my investments. I'm going to finance it. So in other words, you can borrow the money or you can issue stock. That's what we mean by financing here. All right, so if you issue stock, you're going to increase it by the proceeds, the total amount that you got for issuing that stock. If you issue bonds, you're going to increase your cash by the issue price of those bonds, how much you got for it. If you repay bonds, you'll decrease your cash by that amount. If you have treasury stock transactions, if you buy treasury stock, it'll decrease it. If you sell it, you'll increase it by the cash amount. Let's see, stocks, bonds, treasury stock. I wrote bonds here, but it could be any other long-term liability. And that is all I can think of for right now. So then you come down to net cash inflows or outflows from financing activities. And then you're going to net the three together. Your inflow or outflow from operating, investing, and financing. And that is your net cash flows. Right beneath it, you do a little reconciliation. You put your beginning cash and your ending cash, and the change in this must equal your net cash flows. And then you know that you have properly accounted for every change in your cash. And furthermore, you've categorized it as an operating, investing, or financing activity.